Welcome to the Smart Property Investment Show, the podcast by investors for investors.
And here we are for the final instalment of our special series of the Fast 50 2026, where to put your money today for the best capital growth in 2026. Phil Tarrant, host of the Smart Property Investment Show. We've pulled this report apart. We've got more ahead of us. This is our final insights into it as part of our special episode. If you haven't tuned in, you just found us, go back. Episode number 1, you'll find it pretty easy wherever they're tuning into this across any of the podcast players and all the streaming platforms. We've got into Western Australia, Queensland, Perth, all over the joint. Victoria, and specifically, new entrant to the report, and the other suburbs to actually get a sense for where and how you should be deploying your dough to get the best outcome for your property investment journey over the year ahead. But one of the key findings for me was that 36% of all of the suburbs that made the Fast 50 report were in regional Australia. So it gives you a bit of a sense of the balance. Even though the majority of Australia's populations live in the capitals, regional property as part of the Fast 50 report seems to outperform when it comes to deploying your dough for the best capital growth. Here to help me sort of navigate a discussion around it and give his insights, because he is investing in regional Australia, maybe not the regions you don't think about or how it looks for you, is Paul Glossop. He's the founder and director of Pure Property Investment. Back in the studio, Paul and his team have again been our principal partner to put this report on to help corral the 14 experts from right across the spectrum of Australia's property industry to help put this report together. And you can see the methodology in the report, smartpropertyinvestment.com.au, or listen to our first installment of this episode where we broke down how we got around to picking the 50 suburbs out of the 11,000 in Australia where you should be deploying your dough. Now, that's very specific for us. But again, going back to our first installment of this series, the score sheet's not bad, Paul. We seem to pick it in these reports. Welcome back to the studio.
Thank you for having me, Philip. To keep with the theme, I thought you were slightly going to be glitching at the start there for those you were into the different techie terms, but you were paused there for a second. I thought, oh, hang on a second, is he lost his way? No, he got back into it, into Perth. Heavy
Every
glitch.
now and then, it's called a pregnant pause.
Oh, okay, gotcha.
Yeah,
I thought you were glitching for the fortnighters out there.
Yeah, it's not very often I glitch, and when I do, I'll know I'm glitching, but no one else will, right? Part of the skill.
I glitch a lot.
When you sit there going like, oh, God, where am I going with this?
I'm just honest.
I've got to bring it back.
I've got nowhere
I've got
to
to bring it back.
Yeah, I just
But,
defer.
Yeah, when you do something a lot, you get very good at it.
Yeah.
That's
Lee Trevino.
No, it was
More I practice, the luckier I get.
The more I practice, the luckier. That's a good quote.
Yeah.
There's probably a lot of relevance for property markets.
Oh, it's massively relevant. Yeah.
The more I practice, the luckier I get. Yeah, there you go. I'm a lucky. Anyway, I still try. I still get it wrong on this podcasting lark, even though I've been doing it for 10 years. You know, one of the coolest jobs now, according to young people, is being a podcaster and a creator.
Oh, man, it's basically the term of an entrepreneur when people put that down on their business card. I'm like, what does that
I'm a
even
creator.
mean?
Like, you know, I saw something the other day. I'm a creator.
If that's the case, then my 8-year-old daughter's a creator.
Yeah. Of mayhem.
Yeah, exactly. Destruction.
Mayhem and
angst,
destruction.
And soon to be probably hell in my life, no doubt as well.
Oh, God. Yeah, but like, it's the thing that everyone wants to be these days, a creator.
Yeah, and everyone wanted to be an entrepreneur 15 years ago.
Creator economy.
Until they realise that you've got to monetize these things, and that turns into a job and a business. And
that's the biggest issue. Most creators think that you create content in order to sell a course to other people to do the same thing.
Yeah.
It's like
it's Ponzi scheme.
It's just mad.
Yeah.
Anyway, Smart Property Investment's got a course coming out. Watch this space. Thanks for setting me up. Soon to come, smartpropertyinvestment.com.au.
How to become a gazillionaire in 4 weeks.
Yeah. How to become a gazillionaire with doing no work and no capital. Smart Property Investment.
Using other people's money.
Yeah. I've got a new scheme.
Oh, no diggity.
It's a new scheme. What you can do, you don't have to put anything down, but what you can do is that you can take a lease on other people's properties and then pretend that they're yours and rent them out in Airbnb.
Oh,
and,
I've seen. Have you seen that, going doing the trap. So I've seen a few people on the socials and actually
Ask me how, I'll tell you.
but they
Buy my
literally say, "Oh,
course.
today, welcome to a day of me making $30,000 a month by renting other people's property, then renting those properties out on Airbnb." I'm like, first, I'm like, that is highly illegal. Secondly, I'm like, you're posting all of this stuff, your face and everything to do with it. Imbecile.
That's the next big thing, right?
Oh
of
my
how to make
gosh.
money quickly
I
on the
can't-
internet.
Like, if you
I
want to see
wake up. I
alarm
wake up at
bells-
4:45. I go to the gym.
Yeah.
Then I go get a green
Then I have
smoothie.
my greens, yeah,
and then I
my
pick up. Then I
wheatgrass
pick up my
shot.
thing, and I'll sit there and I'll take on 10 new leases
Yeah.
over here, mate. No property investor.
Then I'll hop into my hired Lamborghini.
No property investor is going to rent you your property so you can rent it out to other people on short-term rental accommodation.
Well, mate, if they are, then I can guarantee this whole loophole will be closed very, very, very quickly. And
Smart investors aren't doing it. Like, there's nothing wrong with a bit of Airbnb, but
I'd like to think that you're controlling the asset that you're Airbnb, put it that way.
we're a couple of miserable gits,
We
aren't
are.
we?
So how have things have changed? You'd be all over this 10 years ago.
No, I'm never been into schemes.
No.
I've always, and you've known me for a long time. I've always made money the hard way, which is the slow way, the relentless way.
There's some
Just
clues to that.
Yeah, slow,
Yeah.
not too sharp. But I'm telling you, just go. Don't worry about it. Don't invest in property. Spend all your money
On courses.
on courses. Spend all your money on deposits, on bonds, for leases that you can take on, so you can rent it out to other people.
That's it. That's the go.
And you too can
Oh.
buy a Lamborghini.
You too can look like me.
You too can wear no socks. Jeez, just see the reason why that's
Oh,
God.
dearie me.
Anyway, sorry everyone that's
Yeah.
tuning into this, but anyway,
Yeah, anyway. Regional versus metro.
I don't know if I've got some. No, I don't have proper regional property. I'm a metro sort of guy.
Yeah. I got a bit of regional.
I'm a metro sort of guy.
I was probably going to say the same. I was going to concur with you about myself, but I actually don't. I have quite a bit in regional.
Yeah, it depends what your version of regional is.
Mm.
Now, of the Fast 50, of those which are regional, there is 18 out of the 50, 36%, which therefore would mean if my mathematics is good enough, 54% are regional. Is that correct?
No.
64%.
We're close.
Buy the course. Buy the course.
Buy the course. It's all in the course.
It's called.
It's all in the show
It's all in the
notes.
numbers.
I'm a numbers man.
I'm the
Just
numbers
ask me.
man. For some reason, I had 46% in my head. I couldn't do the math.
I'm glad I said no because it didn't sound right. I didn't actually compute. I glitched.
I'm generally pretty good. If someone throws numbers, I can go, it's about 27.6%.
Yeah. Like, how'd you do that? Well, quick,
Just
but when
to-
it's right in your face, you
Can't
get
help
wrong.
it.
Yeah,
Can't
yeah.
help it.
Yeah. It's a
Should
gift.
see me around
It's
a
a
roulette
gift.
table. It's a gift. Property Rain Man, some people have said.
God.
Property have said.
All right,
but,
so 36% are regional, 64 metro,
Yeah.
and essentially the split is pretty well. I mean, we've already.
Well,
gone
I'll tell
through-
you, 2 in the ACT.
Yep.
This is of the Fast 50.
Yes.
2 in New South Wales, 15 in Queensland, 2 in South Australia. We spoke about SA
Yep.
and the WACD in the last
Yep.
podcast. 1 in Tassie, Kingston. 13 in Victoria. Last year there was 1 by memory.
Yep.
And 15 in Western Australia. And I reckon WA, yeah, you're not going to see 15 there next year.
This is where
No way, man.
I want to know, and this again, question without notice. So get ready with your fast fingers on your Excel sheet there, Philip.
Yes.
I want to know the average annual growth of the regional over the last 10 years versus the metro over the last 10 years, because I think this is, and this isn't obviously for everyone listening, you would no doubt say, you'll be screaming out, well, this isn't all the markets in Australia, so how can this be accurate? Well, it isn't. It's a very, very short sample, but this is a sample of markets that I guess probably people who know a bit more in property than the average person are recommending to buy in each of those two options. Yeah. It would be a very, and I can't see, anyone who's watching this on YouTube or anyone else can see, I can't see what you've just done. And I don't know what the numbers are because I haven't got any spreadsheets in front of me right here. I've got a sneaking suspicion that regional certainly wouldn't have dramatically underperformed major metro in that time. If anything, it might actually even be slightly better. But please correct me if I'm wrong, Philip, but I think this will probably give people a bit more of an understanding that don't get too bent out of shape about necessarily the location. And this might go against what I've said in the past, but you've got to sometimes take into account a whole range of other things to figure out what the long-term opportunities and growth is going to be. So if you don't mind, Philip.
So I've got the numbers here.
Numbers.
So I think the numbers that we have here as part of the Fast 50 is probably a little bit different to what your mainstream holistic, holus bolus, 11,000 core logic stuff would say.
Yeah.
So we've got to preface this. This is like some
Very
of the
s-
some of
very
the
small
biggest experts
snapshot.
in Australia going,
Yeah.
like, this is the place you need to be, right? So what do you reckon the average annual growth? So this is the 10-year average annual growth. So what has been over a 10-year period, which would probably be what it was then versus what it is now divided by
2015 by now.
So growth
Yep.
divided by 12.
12.
Yeah,
Yep,
yeah.
correct.
So if it grew by 100%,
Yep.
so in 10 years, it'd be 10% growth
Correct.
per year, right? It's very blunt tool, by the way.
Yeah.
What do you reckon it is for regional
I'd have to think
of the
maybe
Fast 50?
6-ish.
Nah. 5.45.
Okay. Well, I'm glad to hear that because I'm somewhat confident. Oh, actually, you know what? Oh, no. I'm confident that Metro will be better than that.
Yeah, it is 6.7.
And I'm really glad to see that as the average. And look, if we extrapolated that sample size to be the entire, say, 200 odd that were in the original list,
Yeah.
I wouldn't be betting that those numbers would be dramatically different. And this is where it comes down to trying to think, what are you trying to do here? And why the regional is never going to, for me, give me as much confidence over the long term as the major metro is. And that is point in case for me, Phil. And I guess it comes back down to the volatility. And that shows you that they just, I mean, almost all those regional markets that were in this list this year. And I would ask, well, let me phrase this question again with the abacus out, Philip. What's the last 12 months worth of growth for all of the regional markets in that list?
What did you want, sorry?
The 12-month growth for all regional properties in the Fast 50, because I've got a sneaking suspicion that the last 12 months, the regional markets will show at least, I would say, somewhere in the vicinity of 10, 15% capital growth, maybe even more.
You want an average of the 12-month
Average
growth.
of the 12-month growth of the 30, sorry, out of the top 50, you said the 36% of those suburbs were in regional markets. I reckon that percentage will be well into the double digits over the last 12 months.
So again, to our mathematician friends, it's a bit of a blunt thing to do an average of this, but the average 12-month growth in regional markets, so what
That
it
are
was
featured
12
in the
months
list,
ago,
yep.
14.72%.
Which is fantastic. What's the metro? And I'll go out on a limb. This will be a hard one because I know there's quite a large number of Melbourne markets in there that are low. There are Perth markets which are high, but I reckon the Perth markets will drag this way up because there's some Perth markets in there that are in the 30s and close to 40%.
17.27%.
Okay, so it's still better and
Outperformed.
Still outperformed.
So of the Fast 50 suburbs,
Yes,
the 12-month growth and the average annual growth is better in regional in metropolitan markets
that
than
is
regional.
There you go.
That's the headline.
That is the
A
headline.
lot of people are going to go, well, you're choosing the wrong suburbs then.
Yeah.
Maybe.
Well, but again, like I guess you take this data out further, and we do it all the time at purepropertyinvestment.com. We take the data out further and say, let's just take ourselves out of the suburb, out of the local government area, out of that city, out of that major metro market, out of that state. And then you start to average it all out over the 11,000 odd suburbs on these trends. And you can get this data. There's different ways to get it and scrape it and translate it. But it does refer back to the fact that we are more comfortable in major metro.
So 17.2 versus metro versus 14.72 regional for 12-month growth as a aggregate of the 50.
Yep.
Is 16.35%.
Yeah, better.
16, the whole thing.
Yeah.
So of the Fast 50 suburbs over the last 12 months,
Yeah, they grew by 16%.
Grew by 16%. At an average annual growth is 6.25, which is
good. That's
reflective
pretty
of
much
markets in Australia.
Yeah,
right?
that's about right in the meaty curve of the middle.
And this comes back to the core point with all of this, right? A lot of this is a moment in time.
Yep.
And this is the reason why we say where to put your money today for best capital growth in 12 years. Most good markets, unless you're sort of out in some spurious town somewhere, like most markets in Australia should operate on a generalised normal basis. Some will go outperform others, but you've got the Fast 50 there is 6.72. Now, most people I think would be happy with that as a compounding.
I'd
growth,
take it
right?
every day of the week.
Yeah. If you look at the median quarterly growth, this is very
It'd be
interesting.
low.
3%. A lot of that be dragged down by
Melbourne.
By Melbourne.
Yep. And I always want to refer this back because I do get asked the question a lot when I speak to clients initially is that, well, there's this market and there's this market that's booming. And yes, there is short-term gains to be made well above certain areas which may not show those numbers.
Yeah.
And this report's a classic example of plenty of markets which show extremely good short-term numbers. But yes, we're trying to get a short-term outcome that's going to beat the average so we can recycle equity quicker. However, my above-average preference and where our priority always is that we don't want to buy this for 12 months, 3 years, 5-year hold. We ideally were buying this for a 7 to 10-year hold minimum. I want to be confident that when you settle on this property that we're going to fast forward 10 years and you get that 6.5%, 7%.
What we should maybe do, and it's an important point, and this is just one variation of many different ways you can slice and dice it. Like this is talking about a 1-year horizon largely, but assuming that you should get long-term growth. Yeah, there should be something around where to put your money today for the best 10-year growth, right? Which
it's tough.
It's tough to do, right?
It's tough.
And it'd be pretty bold and ambitious to do so. But what this tells me is that, and it sounds corny and you hear it all the time, it's the basic fundamentals, right? But how, and again, this is generalizing, and people who work in this space are probably going to hate me for saying this, but most people, if you want to invest in shares, right, you're better off just investing on ETFs in the average. Yep. Bet on the average, right?
Yep.
Bet on the historic norms of how things operate rather than specific shares where you try and target
dollar cost average, reinvest,
whatever. Just bet against the ASX 200, and depending, if you exit at a particular point in time, you may get hurt. But if you hold over the long term, and there's arguments to say, and you see people come out all the time, you put your money 20 years in property versus 20 years in equities, right? Like equities performs well. Sometimes it outperforms property.
Unleveraged.
And property people would say that's cool, but it's unleveraged. So I'd rather get 4 times, 5 times the value of that,
6% compounded.
Even if that's going at 6.5%, I'm getting 6%, but I've got 5 times the exposure.
And I've got rental yield,
and I've got rental yield on the way, right? And the yields, depending on the shares that you're buying, is different. So it's horse for course. But back the stats, back the averages, back the numbers, and this tells me that all these suburbs here, most of them will average out.
Yep.
Most of them will average
mean
out.
reversion is something that you always have to have in your mind as to what you should expect over the next 10 years.
So the point is, how do you use the report then, right?
Yeah.
So this is for people who are going, I've got some dough, I've either saved my money or I've refinanced, and I want to turn that dollar into as many dollars as possible.
Buy this course.
In 12 months' time. This is what we're saying. Absolutely. This is where you put your money, right? Yep. And we're not saying this is a long-term, it's going to give you the long-term growth. Look, they're going to most of these will revert to the mean, right?
They will. But I guess the big thing here is that when it reverts to the mean, and this goes back to those numbers that we were talking about earlier, Phil, is that if we're saying what mean are you comfortable with? Because if we go back to saying you bought a $600,000 property and your mean was 5.5%, let's say that was 5.5% for any of those regional markets, and let's just do that as we go here. So let's say you got 5.5% on a $600,000 property. That's $1,024,000 in 10 years. Not bad.
600 to 1 point.
$600,000 purchase price today. It got 5.5% compounded over the next 10 years. That's $1,024,000.
Yeah.
Now, if we go back to the Metro, what was the Metro average annual out of all of those?
6.7.
6.7. Now, this is the same purchase today. They got 6.7 in Metro. It goes to 1.147.
You doubled your dough.
It's $100,000 more, more than $100,000 more. And if you put it in perspective, it's not just $100,000 more. to buy a $600,000 property, if you want to do a 10% deposit plus closing costs, $100,000 will actually get you that $600,000.
So cash on cash return.
Cash on cash return is actually double in 10 years, one market versus another market. And if you want to look purely at cash on cash return, you will get that.
So let's talk about cash on cash return, and we throw around and go, yeah, cash on cash return. Like, so this is the money you put in.
Yep.
How that works for you, because you've got to remember you've got an arbitrage of the debt, right? Like you put a bit of money in to control a property.
Yep. Much
the
bigger.
bigger the upside, right? The bigger the upside means you got your original money, less of that, and that's all free carry, right?
Yeah.
And that's the manufacturing nature of leverage.
That's exactly it, and that's where that's the eighth wonder of the world is the compounded growth. Is where your value is in property. Yeah.
So what does this tell us?
Well, I think for me, if I was looking at what it tells me resounding is that, and I don't want to go out on a limb and say you should only do it, but major metro, or at least markets that are exposed to major metro, on average perform better over the long term.
Yeah, I don't know if
that's what this tells us.
Yeah, I know, but I don't know if that's consistent with, and we're going to have to check on it. We should know, but the whole of the market. However, I think the lens in which you need to view this is the acknowledgement that every single person is at different stages of their investing journey. So for a lot of our, listeners and viewers and people who are downloading the report, they may only be able to invest in regional markets as their first investment because they're capital constrained, and or they want to move faster and not save up more money. They want to get exposure to the market quicker.
Great point.
The regional markets are good.
Great point.
At a moment in time, regional markets are great.
And probably that's an excellent point, Phil, because I think sometimes people are like, well, great, a $600,000 property in a major metro might perform better than a $480,000 property in a regional town. What we haven't actually dissected here is houses versus units, and probably stipulate that this report only refers to freestanding established houses. So you also have a decision in here to say, well, I don't want to buy a apartment, I only want to buy a house. So that also then dictates where can you buy. Or you might say, I'm comfortable sacrificing location for property type. And that's when it goes into a completely different kettle of fish, because you then have to consider a whole range of different things with your land value ratios and a whole range of other things that come with what assets are going to perform better over time, freestanding versus strata, townhouses, apartments, duplexes, and a range of other things that go with that.
Yeah. So your cheapest regional location in the Fast 50, you can get in for sub 400.
Yep.
Your cheapest metropolitan location is Devon Park in Adelaide, which you'll get in for just shy of 500.
Yep.
Right. And then, so of your regional locations, of which there is 18, one of them, in terms of bracket, one of them is sub 400. 8 of them are within that $400,000 range, right? So there's 8 of them which are still cheaper, than the lower end, than the least expensive metro, and then you've got you've got 6 of the regionals are within 500k, and then you've got 3 of them in 600k, and there's only one of them in a 700k bracket, right? But in terms of your regionals, so your average median for the regions is 511k, right? The average of your metros is 789.
Yeah.
So they're different, completely different markets.
They definitely are. But I guess, again, just reiterating that this is what's in the report. I know hands down that there are multiple metro markets that we're buying in right now, freestanding, that'll be circa high 4s to mid 5s. Yeah. There's plenty of them. Now, they're not in the report necessarily. That doesn't mean that they're not investment grade at this stage in the cycle. They might not fit your criteria. So, and there's also to say that there's probably plenty of regional markets which are well below even the lowest price in this report as well. So there's markets that you can get well below that 390 odd K for the SA market property there. That's there advertised as well. So don't be too hard and fast to think that the numbers in here are what I have to work off. I think for me, the property strategy and how that fits your position is where you need to start, and then refer that back. But some of these average numbers are really eye-opening in my opinion.
They are. So go and download the report now. Conscious that there's been 6 episodes, you've probably binged on a car drive somewhere or on the lawnmower or down at the gym, and I hope it's been beneficial and informative for you. So we've given you a whole bunch of information and some of our views and opinions and sentiments towards this. That's all very nice and good, but it's only as good as what you choose to do about it. And you can take on that information and do nothing and tell your friends that one day you're going to invest in property, or you can take action. And I've always found that those that take action in and around property are the ones that will benefit from it the greatest. So if you don't know where to go and you're completely bewildered by all of this, it's okay. You're certainly not alone. Heaps of information on smartpropertyinvestment.com.au, but I know Paul and his team have been more than happy to chat with you about anything we've spoken about. And if you just need some guidance and direction and be told it's all okay not to know.
Yeah. And if you just you want to outsource it fully, that's a big part of what we do as well.
You're happy to do that?
Well, we'll definitely. But I mean, big part of what we do is outsource. We are the outsourcing opportunity for people to buy investment
So you
properties.
can be the executor.
We are 100% the executor. What we want to do is try to give education and inform what people are doing and why they're doing it along the way. Now, you can get heaps of that information off us if you want to get all the granularity, or if you just want to have the top line info to say, what are we doing? Why are we doing it? Okay, thank you. Go and do it, please. I need to get this done.
Yep.
That's what we're a pair of hands to do, and do it with precision and take all of the legwork out of it, from literally searching, securing, negotiating, handling that due diligence process and finalizing the asset, from contracts to clauses in contracts through to building and pest inspectors, property management, tenants, insurance quotes, depreciation schedules, aligning it with your broker to make sure that finance is correct. Every single one of those steps we handle.
It'd be Risabine, and thanks again to our finance partner for the report, finnymortgages.com.au. They specialise in property investment finance, whether it's resi or commercial. They'd be happy to chat with you if you want to actually understand borrowing power and all that sort of stuff.
Absolutely.
You can go, I would start with getting an understanding from that, for some of the calculators on smart property investment, but give the team at Finny a call. If you go to their website, finny.com.au, I often have Eva on the Smart Property Investment Show. She's the head broker over there. They'd be more than happy to help you on your way, and you're best off being armed with a pre-approval or at least an understanding and appreciation for your borrowing power in order to be most effective. Go and check those guys out, have a yarn to them, tell them I sent you. Paul, your team, happy to chat with people. What's the best way to do that?
purepropertyinvestment.com, or they can sling us an email, inquiry@purepropertyinvestment.com, or simply give us a call, 1300 985428.
Thank you for your participation again and partnering on this report. It's important we do it. We sort of see it from a particular lens, but as a media and information company, we're only so limited by our knowledge of understanding it. So it's good to partner with people who work in this space, who are actually making recommendations, tactical recommendations to people on their property investment journey. So the team over at Pure Property has been very kind with their time to help us out with that. So this is the 6th installment of our special episode for the Fast 50 2026. There's 5 other ones. If you just found it, go and tune in to the rest of them, re-listen to them. We're going to be doing some update episodes over the coming period. Send your questions in, editor@smartpropertyinvestment.com. They use the best way to do that. We'll curate them. We'll answer anything. We might even do a bit of a live stream to actually get stuck into it as well. Tell your friends about the report if they haven't yet done so. The whole world and his man knows about, dog knows about it these days. So if you haven't and they're under a rock somewhere, go and tell them. smartpropertyinvestment.com.au is where you can download the report. Social media, there'll be heaps of stuff coming out over the coming period as well, and articles on every single suburb coming out in and around the report. Go and check it out, smartpropertyinvestment.com.au. Thanks for tuning in for this special series of the Fast 50 2026. We'll see you again soon. Until then, bye-bye.